Stock market's doing fine this year, even though there are fears of a global economic slowdown. Our guest thinks, though, that a worldwide recession is likely to be avoided. We're joined by Kevin Headland, co-chief investment strategist at Manulife Investments. Thanks very much for coming on the show, Kevin. Really appreciate it. Even just a few months ago, there were fears that the US tariffs would just throw the whole global trading system into disarray. Those seem to have eased now.
Yeah, it seems, of course, the tariffs have eased a little bit of the pressure. We have some deals as well in place. So that pressure has come off a little bit. And then not only that, but you have had some fiscal spending in places like Europe that have helped support certain regions that overall should help global economic growth.
So you think that a recession, a global turndown, is unlikely at this stage?
It seems so. The R word, as we like to say, and it puts fear in people's minds, seems to be avoided. However, when we look at slow growth, like we've seen with the Canadian numbers today, we should be celebrating the fact that we have below trend economic growth in many regions. Below trend economic growth, of course, is not what we really want. We would love to have a trend or above trend economic growth. So despite the fact that we might avoid that R word, recession, we shouldn't be celebrating the current economic data just yet.
Turning to Canada, you think we will get 2 more interest rate cuts in this country?
It seems like we should have 1 this year and perhaps 1 next year. That 1 next year, of course, is predicated on the data that comes out. Do we continue to see weaker economic data? Do we see weaker labor market data? And does inflation cool a little bit to give a little bit of runway for the Bank of Canada to support that growth? But I think 1 definitely is in price in probably this year. And that second one is still up for debate, depending on that data.
How do you feel? I mean, you do want to stress here that you guys favor investing in companies, not countries. But are you seeing opportunities in the Canadian stock market?
There still is opportunities in the Canadian stock market. As you said, we're reaching record highs. We might breach that 30,000 level and remain above that level. It becomes on a stock-by-stock basis. When you look at the returns so far this year, they have been driven by a couple of sectors, a couple of names, shall we say. But there is still some depth and breadth there. I think, though, investors and perhaps professional money managers are working a little bit harder, given valuations generally are higher than average, but there still remains some opportunity to find good quality businesses at reasonable prices. I don't think we're getting cheap prices, but still at reasonable prices, and that makes sense.
As you know, the scale of planned investment in AI and data centers south of the border and the electricity needed to power them is just stupendous. We're talking hundreds of billions of dollars. Do you think it could be overdone right now, the euphoria?
It's going to be a while until we see the actual accretive value, shall we say, of some of these buildings. Some might be overspending. We really just won't know until perhaps years down the line about how much increase this spend has created in terms of economic growth. Of course, job growth is always important, but it does take time. I think people have to be patient. But when we see this massive investment, it does give pause. But the idea around AI is definitely long-lived and definitely important. This is not a short-term fad, shall we say. So it's important that we are spending in the right areas, and we don't definitely want to be left behind in Canada. We want to make sure we are participating in this new paradigm, I'd say, with technology.
I have to ask you this, and I'm sure nobody would do this at Manulife, but there was a story yesterday in the Harvard Business Review that this new thing called work slop has turned up. People are just lazily prompting AI and churning out material and presentations. Have you come across anything that you suspect could be that?
It's interesting you say that, because we always worried about AI that would replace things and jobs, and maybe even some students are relying on that. Of course, the different chat systems out there are not perfect. There are issues. There are delays in data. We also worried when the internet started that people would be lazy at their businesses. Imagine the day when you didn't have a desktop or laptop on your computer desk and people would be searching and not working. But what actually happens is it creates productivity, and you learn to work within those paradigms. And I think that's the key here is it could be actually very helpful for productivity down the road.
Yeah, although I think brevity, I think from now on, maybe anything above a page might get a bit suspect. It needs to be pretty good before I'm going to read it, because I'm wary that people are just using AI to churn stuff out. Talk to us about bonds. Maybe we'll put up the 10-year Canadian bond yield. We've had steadily falling interest rates in Canada. Are you attracted by bonds at these prices?
We are attracted by bonds, but in certain areas. We still really like the investment-grade corporate bond space, not only in Canada, but in the U.S. as well. Even global bonds, European fixed income looks interesting. We haven't been paying attention to that much from a Canadian investor perspective. So there are yield to be had if you look in the right areas, and prices generally tend to be below average. So there is opportunities there. We don't necessarily want to be what we call embracing duration, so just blindly buying longer-term government bonds here. We want to be more active management, probably what we call the belly of the curve, that 4 to 7 year duration. But again, investment grade bonds look very solid. Corporations are still fundamentally sound. We're not too worried about a shock in terms of a debt crisis or anything like that. So we're really happy with the yields provided by fixed income as well as the price. And they've been doing what they should do during periods of volatility so far. Earlier this year, during the sell-off in the equity markets, especially in the U.S., bonds have helped protect the downside. So balanced investing is, I would say, back. It never really left. Mm-hmm. But at the same time, investors need to be patient for those fixed income returns to pay out. It's not just like equity markets, and unfortunately, they don't just keep going up like equity markets have done so far this year.
Kevin, thanks very much indeed.
Thank you.
Kevin Headland, Co-Chief Investment Strategist at Manulife Investments.